Right. Okay. So first questions first. Stamp duty. Let's talk about the elephant in the room. So stamp duty has obviously changed overnight, which is a good thing. The stamp duty, what's basically happened is that the stamp duty has been removed up to £500,000 for residential purchases, and has been removed except the 3% for investors. So there is still a saving, and with some investors it will make a saving. So it's good. What will probably happen with that is that it will promote some movement in the market. Hang on 2 seconds. My computer is beeping at me. Let's switch these things off. Right, what will probably happen in the marketplace is that it will promote some movement. Anything that promotes movement at the moment is a good thing. What's interesting is that it will also stimulate growth at the start of next year. The end date of this is March 31st. So what will happen in the first 3 months of the year is that we'll probably see a bit of a rush come January. Now, whenever there's a rush, things tend to collapse because people don't do things at the same time. So I would suggest that anybody who's looking to take advantage of the tax breaks essentially does it as soon as possible, and ideally before the end of the year, so that you've actually got time to complete if change are involved. That's important. We'll publish the HMRC link to work out to show you what stamp duty is actually payable on the website, and that will show you exactly what you need to pay, and it breaks it down, which is quite interesting to see. So right, so just a bit about me. I've been doing mortgage lending for quite a long time. I think doing financial services for nearly 20 years, which is a long time. There's very, very little which I've not seen. There's very little that anybody could tell me these days which would possibly surprise me. We really have seen it all, from first-time buyers to people own 150 houses to international investors buying in a variety of corporate entities and moving assets around between families and things. There's always things that people do. I think the place that I always start off with regards to buy-to-lets is really getting things organised at the start, and really the preparation in making sure that you're actually good to go. The majority of clients don't actually seem to understand at the outset that the attention to detail that mortgage companies are looking at now, it really is considerable. The problem that you have is that they have very, very clear underwriting criteria. And in reality, all mortgage companies want to know that you're going to be a good bet. They want to know that they're going to get their money back, and they want to know that you're going to basically pay the mortgage on a monthly basis. Since the rules changed a couple of years back, mortgage lenders are now legally liable for the lending that they provide. So historically, it was down to the advisors. Now it's equally down to the mortgage lenders. So in a way, that's a good thing. But what it has meant is that they've applied a lot of lending criteria to basically ensure that that you're being put in a position that is appropriate. And obviously, they have a slightly different opinion to what is appropriate to what other people do. When they're looking at criteria, they're looking at a number of different things. And some of this may seem pretty obvious, but don't apply common sense, because common sense has got nothing to do with mortgage lending whatsoever. The questions that they're going to ask you: who are you? Are you an experienced investor? Do you own a property in which you live? If you don't own a property in which you live and are renting somewhere, is there a reason for that? It could be that you're living and working in London and you rent there, and that you've invested in property in other bits of the country. Are you an experienced landlord? Are you somebody who's going to be able to deal with the ups and downs and the changing criteria and be able to run it as a proper business? What's your experience? There's lots of people who may run letting agents, for example, who may have all this experience, but technically, as an individual, they don't actually own they don't own buy-to-let property. It doesn't necessarily mean they're a complete newbie to the industry, but they would have had a lot of valuable experience. And I think the most important question that they're looking for is: does this make sense? Does a scenario that somebody's actually bringing to the table actually stack up and you know, does it actually make sense with regards to what you're presenting? And there'll be a number of scenarios that will come up where a lender will just say that doesn't make sense. So I'll give you an example. We had a client a number of years ago who'd inherited a couple of $100,000. Age 25, he was in construction, and when he went to buy his house, the lenders all decided that it was instantly fraudulent, which is ridiculous because he'd inherited the money. As it happened, it was so far outside of the norms that they have statistical analysis, and they decide something is right or wrong. Again, never assume common sense, and that just required some explanations. So the majority of this is about explaining to clients what's the right thing to do, how things work, and just making it, you know, making it work. With regards to looking at incomes and things, one of the things that mortgage lenders will look at when they're looking at incomes is, what is your income? Where's that income derived? What is your basic income? Does your basic income include overtime? Is that commensurate with your contractual terms? Is there a bonus paid in there? Is there 0 hours? And in past years, 0 hours contracts have become fairly prevalent. Doesn't mean person's not earning money. In many sense, people on 0 hours contracts are actually essentially still doing a full-time job. It's just a way for companies to control what they pay. Have you been furloughed? So if there is an income that's coming in, has it been reduced? Is your company paying 100%? Why have they furloughed you? And really, what is the risk? When you look at the market, if you were to say we're looking for companies which are potentially a risk, you would never have thought hospitality, aviation was a risk. If you'd said a risky occupation, I would have said oil rigs or you know, deep sea divers or something. But now companies are looking at financial stability and basically wanting to ensure that you're likely to be able to continue to pay the debts that you're about to take out. They also look at the physical characteristics of what you're actually looking to buy. So when you approach a mortgage lender, and they all have different criteria, obviously if it was a standard 2-bedroom, 1 up, 1 down, then pretty much everybody will look at that. But they look at exposure on a number of different bases. Mortgage lenders will look at the exposure based on the street, based on the town. They'll look at proximity to water, proximity to rail lines, proximity to roads, and you'll get some fairly interesting attitudes there. Simply, all of this at the end of the day comes down to surveyor's comment, and a lot of this will come down to a surveyor basically giving a personal opinion, and those opinions can vary wildly depending on whether he's had a good morning or not, frankly. Is the property that you're looking at over adjacent to anything commercial? Is there a club down the road? Is there a pub across the road? Is there a Chinese takeaway underneath it or nearby? What we regularly see is investors looking at buying buy-to-let properties above commercial units, typically on a main high street, for example, somewhere it can be a fantastic rental opportunity. But if you're above or directly above a main a commercial unit, should that be turned into a restaurant or a club or something, then it may affect the resaleability of the unit. So all of these things are taken into account. So we've got the written criteria, but we also have the unwritten criteria, which frankly drives people up the wall on a regular basis. I continually tell our clients, don't necessarily apply common sense, and let's look at this whole scenario. So when we're talking about unwritten criteria, the published criteria is all online. If anybody cares to actually have a look and see what the written criteria is, you can actually see all of this online. You just need to know where to look. The underwritten criteria really is more about what I would say is common sense, and I think the question there really is sense common? I don't know. when they're looking at that, they're looking for things that don't make sense. Is somebody buying a buy-to-let property where their employed income wouldn't allow them to buy it? Is it basically a Bent's residential? We see a lot of clients who are trying to very legitimately buy buy-to-let properties, but lenders will decline, or certain lenders will decline, simply because they don't believe it makes sense. Now, we regularly see clients who've inherited money, want to buy a string of buy-to-lets, but are quite happy to live at home with mum and dad. With an increasing age of people not necessarily wanting to move out of the family home, that makes sense in my head, but justifying that can sometimes be slightly different. If you're buying a buy-to-let, they're going to look at things like, what's the practicalities of you being able to rent that property out? So those people who've bought HMOs, for example, in student regions, a fairly reasonable question at the minute is, are you actually going to be able to rent that property out? And are you going to be able to do so on a basis where your business model is basically going to work? Now that kind of makes sense to me. We've seen some clients recently who have had HMOs in London, and where the entire HMO has been, all of their tenants have moved. Luckily, they've all been replaced. But from a mortgage lender's point of view, if they're going to lend you X amount of £100,000, then they want to make sure that that business is basically as good as it possibly can be. It's not just tenants. We have lots of clients who've bought properties down in South London, for example. So Gatwick as an example. So Gatwick as an area is going to see a fairly sizable impact from people who bought buy-to-lets, simply because all the aviation's moving out there, or it looks like a big chunk will be moving. So mortgage lenders are looking at the viability, not just based on the facts and the figures, but basically seeing what's going to happen. They're looking at seeing the impact of COVID-19. Now, obviously, we know about that. I'm not going to bang on about this, but we know that it's had a huge impact on the country, and it's had a huge impact around the world. But what they're looking at is the financial impact and what that suggests about the viability of a buy-to-let business model, whether it's HMOs, buy-to-lets, commercial, whatever. So what they're looking at there is has the whole COVID-19 issue been an issue? Have people used bounce back loans, for example? Are people trying to use bounce back loans as a deposit for a house? That's obviously a no-no. Are businesses, or have businesses used, applied for the bounce back loans, and have they used them already? Because there's plenty of businesses would have used it to pay debts off, to upgrade equipment, that kind of thing. All makes common sense, cheap money, why not? But from a mortgage company point of view, it suggests that the business is potentially not as stable as it could be, which, looking at how it was originally marketed, when the Chancellor stood up and launched these things, we were all assured that it wouldn't actually impact our lending, and that it wouldn't be held against us. And lo and behold, it is to an extent in some cases, but ultimately, I just think we need to be sensible about what we do about that. Mortgage holidays are a big one at the minute. We've seen lots of people recently who have taken mortgage holidays, some because they've had tenants try and skip on pay, some because they thought it would be a good idea. The first day this was announced, we had clients on the phone asking, and frankly, if we've got clients who are heavily geared for whatever reason, and I've got lots and lots of properties and lots of tenants potentially not going to pay, then yes, it makes sense. The majority of those clients have actually paid back the amount that they would have paid, which is a sensible thing to do because it demonstrates that everything's cash flow positive. But in reality, again, mortgage companies are just looking to make sure that companies, buy-to-let business models are able to sustain themselves. What we're also seeing is that mortgage companies are taking a negative view, where people have taken mortgage holidays or are relying on bounce back loans, and where people are trying to debt consolidate, because it's fairly straightforward that if they've borrowed money there, then potentially they're not going to be able to pay back if you were to then increase the debt. So it's kind of swings and roundabouts, really. I just think you need to take an overall view of what we're actually looking at with a portfolio before we kind of get stuck into disclosing anything with lenders. Disclosure with all these things is incredibly important. We regularly hear from clients that they've been told that it's a soft footprint and nobody can see it on the credit score. The banks and the building societies share all the information. It's very, very clear, very, very well documented. It's anti-money laundering. Just because you can't see on a credit score does not mean that it doesn't exist, because that would render fraud, fraud principles basically null and void, and that's clearly not the case. The market minute is incredibly joined up, and that's really important, because you can't just put an application in with Santander, for the example, and if that doesn't work, go to Halifax. I spoke to a client this morning who's been to see 2 other brokers and went to Nationwide, and that didn't work, and then he's gone to Halifax with another, and then he's gone to another one. It's just like the job needs to be done properly. This isn't throw a dart at a board and see where it lands. The great thing about the industry at the moment is that lending criteria is so publicly available. It's actually very, very straightforward to do the job properly, just by having the data. And 9 times out of 10, that's just about asking the right questions and doing it properly. One of the most important things we do with all clients is do a proper conversation about what they're actually doing, what they're trying to achieve, how they got to where they are. It's not always clear from numbers and data on a sheet as to how people got to where they are. It's also not necessarily clear what people's emotional attachment is, and some people have different attitudes with regards to different properties. So it's worth asking the question. Ultimately, you guys are the clients here, and our business model is centric to what clients want to do and achieve. That doesn't necessarily mean that you'll always hear what you want to hear. If you went to it's a silly analogy, but if you went to a cancer hospital, the doctor's not going to say everything's clear and dandy just to keep you happy. They're going to tell you the way that it is, hopefully with a nice bedside manner, which is important. When we're doing applications, there's a number of things that we ask for. And one of the reasons that we ask for what we ask for is because we want to know that we're going to be able to fulfill what you want to achieve from the outset. Doing this job, if essentially mortgage broking in the industry, is not about, it's not about necessarily giving you exactly what you want, because that's not how the lending industry works. Otherwise, we'd all have £1 million with lots of with lots of cash flow and an unlimited open facility. The way that we do this is really straightforward. The initial email that we send out to all clients is comprehensive, and it's designed to ensure that we can cover off pretty much any eventuality that we might want to see. It obviously includes a fact find in terms of business letter, privacy notice, the standard stuff. But I thought it'd be valuable just to go through some of the things that we actually need to see. So proof of ID and address sounds like a really simple one, but we regularly have clients who have different names. It could be different international versions of a name. It could be the fact that they've got slightly different names with a husband or wife scenario, or on bank statements. Things change. People don't necessarily update the financial institutions that they deal with. So the reason for asking we normally ask for a couple of bits of ID is to make sure that the applications are absolutely correct, and make sure that we're fully aware of anything in there which doesn't necessarily stack up just from a bank statement. It could be that something's in a maiden name, or there's lots of other reasons why. We always ask for credit reports. And the reason that we ask for credit reports is really simple. The way that banks credit score these days is very much the computer says yes, computer says no. And even if they don't work necessarily on direct credit scoring, as some of them do, they still work on that basis. By getting a copy of the credit score, we're able to prove to a bank that if they're picking up something that isn't quite right. So for example, when I tried to apply for a mortgage in the past, my twin brother's details have come up because we've got the same date of birth, we've got the same surname, and historically we've had the same address. We've had 2 other sets of twins in the last 12 months who've had exactly the same thing. So things like that are really important and really straightforward to actually work out. We typically ask for any copies of any debts that you have, and any bank statements or credit card statements that show that, simply because your credit score doesn't necessarily accurately reflect 100% of the debt. So we know that some credit card companies, for example, who don't file data with Experian or Equifax. It's important because if we've missed something, or something that you've not disclosed, just because it's fairly easy not to disclose, that if a bank ever does pick up something that we've missed, then it would just lead to a decline. So it's much, much easier just to ask up front. With regards to pay slips are a relatively straightforward thing, but we regularly see pay slips that don't match the contractual terms on your contract. And that could be because you've been paid bits and pieces from holiday, overtime, whatever. Because a bank will typically ask for the last 3 months, it's really important that we have the right information and that we basically provide that in a way that they want. In many cases, if something doesn't add up, it's just a case of delaying an application for a while. We regularly see smaller companies or family businesses where someone's employed, they might pay them on a different date, or the amount they get paid might be different. It's usually, well, it's always easily explainable, either through the company's accountant or through an employer. But it's important to know that before you submit things and have a problem. If you're self-employed, there's a number of different things that you need to think about. Mortgage companies will typically underwrite either on the profitability of the limited company, alternatively on your SA302 data or your tax calculation data. All of this is really easily obtainable from your accountant, and if it's often easier that we speak direct to your accountant. And what we do is we pull that together and work out which is going to be the best scenario. In some cases where rental is short, we can use some earned income to supplement rental income, but it ensures that we have a true picture of what you're actually doing, as opposed to what the numbers say. But also bear in mind that obviously your tax data is going to be somewhat out of date, just because obviously we file our tax returns in arrears, essentially. It's probably appropriate at this point to talk about tax structures. Now, tax structures generally, the majority of people will buy as sole traders or as a limited company. Now, we are not tax advisors, I must say that. However, it's my job to point things out and ensure that you get the right advice at any one point. So if part of that includes getting proper regulated tax advice, and this isn't a wing and a prayer from your standard administrative accountant, then it's important to do that. So I'll give you an example. I spoke to a client in the last couple of days whereby an accountant had suggested buying part of the property in a limited company, which frankly, legally, you could do that. That's not a problem. But from a lending point of view, the name on the deeds needs to be the name on the lending, so that wouldn't work. Typically, if you're setting up a limited company, there's a number of things that you need to think about. First of all, you need to think about who's going to own that limited company. Secondly, you need to think about what that company actually currently does. So obviously Elizabeth's got the question about buying as a limited company. If you're buying as a limited company, we need to make sure that that company is going to be able to get the finance. So if you had a limited company that was previously a consultancy or a retail company, then there's actually going to be very few companies lenders who would actually want to lend to it, simply because they're concerned that with a trading entity that they'd actually be able to get their money back should somebody decide to have a go at it, for example. So most companies will only lend to a limited company, which is a holding company, a limited company which does nothing other than facilitate the home of a property. That's it. And on that basis, when they're doing that, the account should be very straightforward. They should be very simple. Basically, what it means is that it's kind of black and white. They know what they're dealing with. It's not performing any other functions other than that. Now, that also means that it's much easier to work out any impact on any current income. So, for example, if there's any income coming at the moment, what is it? What is the retained profit? What are the director's loans that are outstanding? that kind of thing. It's a much, much easier way of establishing where you are and what you're doing. Obviously, any property purchases moving forward, you can buy more, you can put more money into that limited company. But by keeping it clean, i.e. only having one function, it's much, much, much easier. And it's much easier for an accountant to establish the impact of any one property. Does that answer your question, Elizabeth? Where have you gone? That answer your question? What I would suggest that you do is, before you proceed with anything, it would be worth having a conversation jointly with your accountant, because a lot of accountants will not necessarily understand, and why should they, because it's not their job, the implications of lending on a buy-to-let business model. And I think it's much, much better and more beneficial to have a three-way conversation rather than for us to say, oh, well, this is right or this is wrong. And they'll say, oh, from an accounting point of view, this is right or this is wrong. Have a three-way conversation. It's much easier. And I just think it's more respectful to accountants, really, because it's much faster for you as a client. Gav's got his hand up. Yep.
It's probably a good point at this stage to talk about a question which often comes up. I think we tend to attract quite a few business owners as clients, and business owners who've maybe accumulated capital within their limited companies so let's say, for argument's sake, that they run a construction firm. No, that's a bad example. It's too close to property. Let's say that they run an accountancy firm themselves. And they've acquired an amount of money within their limited company that above and beyond what they need for working capital. And the reason that they haven't drawn the funds as income is because they don't actually need the money themselves until they retire. So they're keeping it in there. There are scenarios where you could actually, this is why it's important to speak to an accountant and a mortgage broker at the same time, because the accountant might suggest that they could have a subsidiary company where they loan money from one company to another. Now, if that's going to be the case, then the mortgage broker needs to have an understanding of that so they can work out whether the lender's going to have a problem with that. So I think having these conversations early on is really important before you start purchasing property. Having the conversation with the mortgage broker, with the accountant, make sure that they speak to one another and realise that this isn't coming from a perspective of egos. It's about it's having the client as the central person who's got to benefit from this, and making sure that everything's joined up, really. So I just wanted to kind of interject at that point and say, with enough planning, there are generally ways to work with these things. That's it. Oh, you're muted.
What I was going to say was the next point was the team that you have around you. So essentially, whenever you're going to plan to do anything, you need to have the right team of people around you to do it. There's a number of people who basically have an impact on your end result. One of them is obviously going to be an accountant, because you should always have some tax advice on your team. That's incredibly important, but rarely the first place that people start. You need to have somebody to facilitate the lending. So that's where we would come in and make sure that all stacks up. And you need to have a lawyer. So you need to have somebody to do the conveyancing and make sure that you're legally allowed to buy the property and the person who is selling it is allowed to legally sell it to you. The issue that most people have is that people spend too much time playing egos and throwing stones at each other, when in reality, if you actually got those three people at the table in one go, it would be much, much, much easier, because there's a lot that you can do from an accounting point of view that doesn't necessarily make sense from a legal or a finance point of view. And the most restrictive point is always going to be the finance. And that's purely and simply because the lenders are looking to ensure that they have security over the asset in the event that you don't pay the bills. Simple as that. It is a good idea to have the conveyancing is kind of slightly separate, but it is always a good idea to have a direct conversation with accountants, which is why we always try and do that at the outset, to ensure that what your accounting is trying to do actually stacks up with regards to getting the finance. Because if you can't do one, the other one doesn't work either. Does that make sense? Right, there's different, with regards to buy-to-let lending, there's a variety of different approaches in the marketplace. There's lots of lenders doing lots of different things. In reality, my opinion is this whole COVID-19 episode has been really good for the industry in the aspect that has encouraged the industry to be more communicative, to be more dynamic in their decisions than they've ever been. Which I think is a good thing. It's encouraged new ways of working within banks and building societies, which I think is a phenomenally good thing. And most importantly, I think it's going to open up the alternative lending sector massively, probably come September, October, when we're out of the furlough period and out of the mortgage holiday period. Whether people are doing buy-to-lets, HMOs, or whether people are looking at using existing lender facilities to do further advances to get more additional money out, the application process is still going to be the same. I think there's going to be a huge number of opportunities out there for lots of different people. There's going to be lots of people looking to offload stock in anticipation of a drop. There's going to be lots of people looking to buy, and we've already got clients who are looking to stockpile cash and get facilities in place so they're in a position to go and buy right now, which I think is a really good idea. Yeah, Elizabeth, let me jump in you. Hang on. Sorry, do you have a question? Okay. Phil, could you unmute Elizabeth, because I can see waving, but I obviously can't hear her.
No, sorry
Elizabeth.
No question.
All right. Okay.
I'm agreeing, and I think it's my. I'm still getting used to the Zoom things.
Oh, don't worry. We all are. It's all good. It's all good.
Sorry. Apologies.
No, it's all right. Now, with regards to raising cash, there's a variety of ways of doing it in the current marketplace, other than raising money against your existing one property that you're looking to buy. When you're looking at raising cash against an existing asset, it's a relatively straightforward thing to do. Ultimately, you can either remortgage the entire asset, which is quite a simple thing to do. Alternatively, you could do a further advance. So a further advance is very simply you'd be reapplying to the same lender for an additional advance, so essentially a secondary mortgage amount. Alternatively, you could do it on a second charge basis. So there's lots of reasons whereby, let's say, for example, you had a 65% loan to value mortgage on your existing unit at an amazing interest rate. It may be that it's much, much better for you to try and do a second charge elsewhere. So going to a different lender and asking essentially for a secondary mortgage, whereby you can raise money on that basis. In many ways, that can be more flexible. It can sometimes be faster. The benefit of doing a further advance, however, is that there'll be no legal fees because they already have a charge. But in many cases, it's worth looking at lateral options as opposed to just making an assumption. We always take into account any early repayment penalties with existing mortgage lending. And that's incredibly important because you may have the best interest rate in the world, but if it's going to cost you an early repayment penalty of $5 or $6,000, in many cases, then that can negate the benefit of doing it. So it's really taking a 360-degree look at what you're actually trying to achieve, and then working out the best way to get from A to B. We typically will speak to clients where it may not be the best time from a financial point of view, to pull the money right now because of tie-ins. It may be a case of saying, what can we do in 6 weeks or 2 months or 6 months? It's not a problem. I think the beneficial thing to add there is be in a position where you can put timescales on what you're actually trying to achieve and add clarity to the position. And if it is a case where you need to wait, well, that's great. It's not a problem. If it's better for you to wait, then you should do so. It's certainly the bad idea to jump in and start moving all your finance around without looking, first of all, at the end goal and working out what the implications are. I heard somebody else saying yesterday, earlier in the week, that you should always try and go for a lender who will allow you to do further advances in the future. So one strategy of buying property that you're going to refurb is if you can buy a property that's mortgageable using a buy-to-let provider now, and then once you've done it up over time, you can then take a further advance. Now that works. However, obviously the property needs to be mortgageable and rentable in its current situation, obviously with intention to do so. And you need to be relying on the company to actually do further advances. Now, one thing that I would remind people on that basis is how good Northern Rock were once. Northern Rock were historically fantastic. However, Northern Rock went. So when you are obtaining your lending, don't necessarily do so on the basis that you are definitely going to be able to get a further advance, regardless or not of whether or not your criteria fits it right now, because banking will change, criteria will change, your circumstances will change. And this is about facilitating what you want, not relying on the banks, because they can't be relied on. If you look at the COVID-19 scenario, they've all been impacted with unprecedented circumstances. It's not their fault. It's just they've had to change things to remain in business. And as I said, I think it's been phenomenally good that the banking industry has been so dynamic in the changes that they've been. I mean, it's just amazing. I mentioned a bit about tax structure earlier on. One thing that I think is really worth emphasizing is that if you're going to be in property, you need to be in it long term. Doesn't matter what your strategy is. If you're raising finance and making disclosures to banks, which you obviously will do, you need to be in a position to know that what you're saying stacks up for the deal that you're doing right now, but also stacks up for the deal you do in the future. One thing that you will find is that banks remember. They have this incredible ability to recall data and even stuff that we haven't told them about. We have in recent months been asked about deals that clients have done with other people. Like, well, hang on, we didn't do that. So, for example, where clients have consolidated debts in the past, or where they've moved mortgages. And my initial question is, well, hang on a minute, how would we know? But it's our job to know our clients. It's our job to know what our clients' financial position is. And ultimately, it's our job to make sure that clients are aware how banks are likely to treat them in the future. So, for example, if you're making a disclosure that you're raising money to buy a property, you need to have the intention of raising that money to buy a property. If you use it to buy a Ferrari and then go back and raise more money to buy a property, they're going to come back and say, well, what happened to the last money that you said you were borrowing to buy a property? Where did the property go? It's all about just keeping everything straightforward, keeping everything clean, and making sure that you don't dig yourself an unnecessary hole. Things change. Banks understand that completely, but it's incredibly important that everything stacks up. If you say you're going to be debt consolidating, you need to debt consolidate, because banks now double check what you've done post completion. And if part of the contractual obligations is that you were going to do something, then you really need to make sure that you've done it. I mentioned that they're all incredibly, linked. So when you put in a mortgage application, there's a variety of things in there that link into a variety of systems. So for example, historically, this started off years ago when the Inland Revenue thought it'd be a great idea to start monitoring what's going on, because it kind of makes sense. And so what they did was they added a national insurance number to the stamp duty land tax forms. And you think, well, that's quite a good idea. Well, nowadays, it's so far advanced on that, it's ridiculous. Your bank account details, your basically everything that you do is already linked. So if a bank wanted to evidence what you've done with credit score, bank accounts, money movements, property sales, property purchases, they can do so in a heartbeat. They can do so literally as fast as it would take you to upload your emails. And the importance of that is that you have to do things properly if you want to be in the marketplace long term. It's incredibly important that if things do come out the woodwork in a mortgage application process, that you tidy them up, put them to bed properly. If there is tax outstanding, get it sorted out. The revenue currently has a fairly open policy of allowing people to bring things up to date, currently. And that's a good thing. So if people haven't disclosed tax, they should bring it up to date immediately. Use a mortgage application process to plan moving forward to ensure that what you're actually going to be doing, it has longevity. There's no point in trying to fudge stuff, because you can't fudge stuff these days. It just doesn't work. Everything's electronic, everything's reportable, and essentially once you've done it, before you've even disclosed it, it's in the system. And I think that's incredibly important. It also makes it a lot easier. If you know what your plan is moving forward, it's much easier to paint the right picture and make sure that all the right explanations are in the right boxes, because we have lots of clients who have lots of different circumstances for lots of different reasons. Probably appropriate to bring in a bit about estate planning here, which isn't really necessarily about buy-to-lets, but I think it's incredibly important. All of our clients are buying properties for a reason. They're typically buying properties to benefit family, to benefit themselves, for retirement planning. If they're buying young kids, it could be school fees further on down the line. It can be all sorts of things. It could be a home for business. When you're doing that, it's incredibly important that you make sure it's suitably protected. Everybody talks about things like wills and lasting powers of attorney, but very few people will tell you to do a lasting power of attorney for a business, for example. If you're building a property empire and it's on a limited company, yes, you own it. But yes, that limited company is its own legal entity. Now, if you don't have the right estate planning in place and something happens to you, your family can't put their hand in the till if they need to. And that may be wholly appropriate at some point in time. If you are looking at ensuring that the family benefit from what are effectively the beneficial shares in your limited company, you need to have the right estate planning in place. But I think the most important thing while everything's up and running is things like lasting powers of attorney, to ensure that somebody can make decisions about your property and about your portfolio and about lending in the absence that you're unable to do so. Just because you stand as guarantee or guarantor, on a limited company debt doesn't necessarily mean that somebody can ring up on behalf of that limited company and make any changes. So that is incredibly important. Again, sometimes that means that what your accountant says with regards to moving money around may differ from what an estate planner will say. And that's an important point. If you also may differ from what a mortgage lender will say. So it's an important point to have those conversations up front. And really, as part of your team, be having the right conversations to put you in the right place before you even start. It sounds kind of silly because people don't view, if you said somebody was setting up IBM, you'd think you'd have a finance team, you'd have a legal team, you'd have HR, you'd have your banking team, you'd have your facilities management team, your property team. Actually, all these things largely apply to the property business that people are setting up, however it's owned. And it's incredibly important that you take the right advice from the right qualified people at the right time and do it properly. And if that takes you a couple more days to do things, take a couple more days, not an issue. It is incredibly important that you do things right and put the right training and the right time into doing it. Otherwise, you can nullify the whole benefit of doing it. You get your tax bits and pieces wrong, it can make a colossal difference, which I think is important. As with everything, we take a collaborative approach to these things. My view is that it's better to have a conversation about it. From a compliance point of view, we always have to back things up in writing anyway, so that's not an issue, as do accountants, solicitors, so it's not a problem. But I think so much is lost in communication by email, and a lot of the time it's better just to have a proper chat. If this was old school, we'd have a meeting around a table, and 4 months ago we'd shake hands and have a cup of coffee. I hope that comes back because it's really strange. But yeah, communication is a good thing. I think it's important to talk to people. It's important to listen to the different viewpoints. And then if you decide that one way or another is better for you, that's cool. That's not a problem. but everything that you do, just move forward, understanding what was the accounting advice, what was the legal advice, are we doing something because we can't do it another way? Is there a better way to do things?